Good afternoon. We're ready to start our webinar. Welcome. We're going to do a webinar this afternoon on the ins and outs of escrow. This is part of Sunbelt Business Brokers' Exit Strategy series that we've offered to our clients for over a year now. Most of these webcast presentations are here to educate business owners so that when the time is right for you, for your next venture or for retirement, that you're going to be well positioned to minimize taxes and maximize what you walk away with at closing. I'm Joan Young, the president of Sunbelt Business Brokers. And by the way, I'll give a plug. Sunbelt is the largest business brokerage network and mergers and acquisitions firm in the world with over 235 offices. So our office is based in San Jose, and we've been helping buyers and sellers throughout the Bay Area for 15 years now. Joining us today is Sue Berry with the office of William Dunn. And since the 70s, the law office of William H. Dunn's been synonymous with business sales escrow in Santa Clara Valley. If you've sold your business in the past, you've probably worked with Sue Berry. Sue's been there for 22 years and an integral member of the William Dunn team. Her expertise in the area of business, bulk sales, liquor license transfers have really virtually benefited thousands of clients over the years. And the repeat customers is really a testament to her commitment to provide timely, accurate, and courteous service. So welcome, Sue.
Thank you very much. Glad to be here.
So we have 10 minutes at the end of our session for Q&A, and you'll notice on the left-hand side at the bottom is a place for you to write your questions. So we'll be looking at that at the end and hopefully be able to answer as many as possible. And if you didn't get your questions answered, feel free to call Sue or myself, and the numbers will be up at the end. So if you kindly put your phones on mute, we already have you on mute, but then when we unmute you, we'll only hear the person that we're talking to. So thank you. Okay, Sue, we've got some questions for you.
I'm ready to answer.
Okay, so we're going to talk about really what escrow does. So you want to start with probably the first thing that you do?
Sure. When an escrow opens, we're going to be provided with a purchase agreement, which is going to come in from the broker. And based on that, the sales agreement, we are then going to prepare escrow instructions, which is a contract between the buyer and seller and our office. That's simply what it is. It's an outline of the steps that we take to make sure that the business transfers free and clear of any liens and encumbrances.
Okay. And so that can be done remotely or at your office?
Absolutely. More and more transactions seem to be done remotely. But we still get, quite a few coming into the office from local brokers.
Okay. And when you first start that, you get a deposit with those?
Right. What we need the good faith deposit typically comes in, and we do need that to start our process.
Okay. So that's going to cover, at least cover your expenses.
Right. That's going to cover our initial expenses, and we don't have the parties put in anything over and above the good faith deposit. We'll just work from what comes in.
Okay. And what else do you do?
So we have our escrow instructions. Once again, in there we're going to describe what we're going to be doing. We'll tell you what the escrow fee is going to be. If most escrow fees are split between buyer and seller, but anything is negotiable, and that would appear in the sales agreement. So we'll let you know what that is. First and foremost in our instructions, we talk about the bulk sales law, which is a law that applies to some businesses, but not all. It's bulk sale compliance. It's referred to as that. And it's a law that requires the escrow holder to publish a notice at the same time that this bulk sale notice is published in a legal newspaper that's in the jurisdiction where the business is located. The document is also recorded, and then a copy is sent to the county tax collector. So those three steps make up the bulk sale compliance. And the purpose is to advertise the sale, put it out there, and it allows creditors of the seller to put a claim into the escrow. There is a time limit with the bulk sale. From the date of publication, you've got to wait 12 business days
from
the publication date before you can close the escrow. And it's that 12-day period where any creditor of the seller can put a claim into the escrow.
And one thing I'd like to add is I know for years in this business I thought that notice was out there for 12 days, but it's really only published one day, isn't it?
It's right. It's just one day only.
Right.
It publishes.
And
yes.
so I was told it's a really old law that's been on the books forever, and you know the chance that a creditor would see that the one day it's there,
right?
Or
right. It's pretty slim, and I know it really was initiated to protect creditors because so many creditors didn't have the opportunity to get paid, and you know, unless the seller tells them.
Okay.
And so that's basically why it was designed.
And let's talk a little bit about what kind of businesses have to comply with the bulk sales law.
So a business that falls under the compliance is one whose major source of business is stocking inventory for resale, and also restaurants and bars. So it does not apply to all businesses. Think of a retail business. You know, a
dry cleaner.
Dry cleaner does not fall under the compliance. Mom and pop market does fall under bulk sale compliance. A company that manufactures what it sells falls under the compliance. Again, restaurants and bars fall under it. So a lot of people refer to a bulk sale as applying to everything. I think they just refer to as a sale of a business in general as a bulk sale. But it's, I mean, it is a sale of the bulk of the business, and maybe that's what's being referred to. But the bulk sales law is specific to a certain type of business.
Okay, so what would a seller and a buyer, time-wise, if there's a bulk sales compliance that it needs to be done, as well as your lien searches and other things you do, should they allow at least 3 to 4 weeks?
You do need to allow that much time. The reason being, all papers have a lead time.
Okay.
So depending on where the business is located, the paper that covers that jurisdiction may only publish once a week, and they have a cutoff period. So if escrow opens on a Friday, let's say, and we notify the paper that we want to publish on the next available day, and the cutoff for that paper was at noon on Friday, we would miss the cutoff. We would have to, and again, I'm referring to a weekly paper in this case. We would miss the cutoff for that weekly paper,
so
and it would add an extra week. Of course, it's much easier when you're working with a daily paper, and they might have a lead time of 2 to 5 days, and we're usually able to get it in the paper within 5 days of opening.
Okay, so let's say it's a business that does not require bulk sales notice. Would 2 weeks be enough time?
2 weeks is enough time. You know, we do rely on the tax agencies that we contact. We have to rely on them to get back to us, and they need a certain amount of time to process our request, but we can get our process done in that 2-week period.
Okay, good. Good to know. And could you address a little bit about lien searches?
Okay. Lien searches is one of the steps that we take to make sure that the business is transferring free and clear. It is a search of the Secretary of State records and a search of the county records. We're looking for tax and judgment liens at the county level, and secured creditors or UCC filings at the state level. And secured creditors and tax and judgment liens don't go away because a business sells. So when you refer to a secured creditor, that is someone who has an interest, a security interest in the business assets.
Okay.
So it might be a previous
Partner?
Seller of the business who took a note back, and let's say this seller took a note back, and in order to secure their note, they put a UCC lien on the business assets.
Okay.
It could be a finance company who sold some equipment to the business, and in order to
go ahead.
What's the word I want? Secure that piece of equipment, they put this lien on it so that if the seller of the business goes to sell, it's going to come up that that piece of equipment is encumbered.
So this is really helps the buyer
Very
from
much
getting
so.
getting stuck
right.
with anything.
Because the buyer, you don't want the buyer to get stuck with any of this liability. And tax or judgment liens, again, do not go away because a business sells. Some of them do have a statute of limitations. So if let's say there's a small claims judgment that is more than 10 years old, in all likelihood it's been taken care of. It just wasn't released. But if it's not something we would have to address if it's that old.
And then if you find something, you let the seller know, and then they cure it?
Right. Well, we let the seller know what we found, and we ask them how they want us to move forward. If, we want to give them the opportunity to explain to us why it's there. They might have a story behind some type of security interest. They may also give us the information right up front and say, this is a loan that I'm paying off, loan from a previous owner. So,
is that typically paid off through the proceeds?
It would be paid off through the escrow, so that before the seller gets their proceeds, any of this liability is going to be paid off.
Good.
Yeah.
Okay. And I know there's always lots of questions about tax clearances, so I'd love you to go into those.
Okay. Again, another one of the steps that we take is to contact state tax agencies, and that includes the State Board of Equalization, which is the Sales and Use Tax Agency, the EDD, which is the Employment Development Department, and the Franchise Tax Board, as well as the County Tax Collector. So these state and county agencies impose what's called successor liability. So if the seller sells their business and for some reason decides not to go through escrow, or the buyer feels it's not important to go through escrow, and the seller has, let's say, sales tax liability that they owe, without and doesn't disclose any information, when that information is discovered, and it might be 2 or 3 months down the road, and let's say the seller has relocated, can't be found, and it's discovered that he left $2,000 that's owing, eventually the buyer is going to have to absorb that liability.
Unless he can get the seller to.
Right. The tax agency will attempt to collect from the seller, but if they can't, they're going to impose this successor liability. And
so that's one of the main safety nets of going through escrow versus avoiding going through escrow and just doing it, because a buyer and seller a buyer won't know, and a seller may not want to.
It is very much so, and I hear quite often a buyer will tell me, but I'm not buying any liability, I'm only buying the assets of the business. They don't understand why they could be responsible for this tax liability, and again, it's this successor liability. It's this little carved out section that doesn't
really
protect them from this liability.
So that's why these lien searches and the tax clearances are so important.
Yeah, it's very important.
Talk a little bit about, I know when we open escrow with William Dunn, is they often have to withhold some money.
Right.
And they often have to wait maybe even 2 months before they get it cleared. And so could you talk about that?
I will, yes.
Which one of those agencies?
So of the 4 agencies that are listed up there, the State Board of Equalization, or the BOE, will not issue a tax clearance until the seller can close out their account. And of course, the seller can't close out their account until they're done doing business. And typically that's going to be close of escrow. So to get around that issue, we talk to the tax agency. They tell us what they want us to hold back, and that is based on what the taxpayer pays monthly or quarterly, depending on how they file their return. And so let's say the state board looks at, sees that they pay $2,500 a quarter. they're going to inflate the figure, and they're going to tell us to hold 2 or 3 times what the taxpayer typically pays. And that would be in addition to any accounts receivable balance that is on the books. So sellers are sometimes very surprised because they don't owe that much money, and it's not anything that we're paying to the state board or to any of these tax agencies that they also suggest we hold a reserve. It's a ransom of sorts in that we hold the money so that you file the paperwork that's needed to close the account.
Okay.
The agencies need that paperwork filed as much as they need payment.
And they probably can't do that until after closing.
Right, they can't,
they're paying their payroll.
Right, with the state board, you have, right up until closing, you may be collecting sales tax. So at the end of business that day, the seller could file a return, a tax return, to determine how much is owed, and they could pay that final tax. And once the state board receives all their necessary filed paperwork and returns and payment, then they'll issue the clearance.
So does EDD ever hold anything back?
Not very often. We typically get the clearance from the EDD and the Franchise Tax Board within a couple of weeks of requesting them.
Okay.
If the only time we don't get it is when it comes along with a demand. It may be that the seller owes money, and so we'll get a demand, and they refer to that as a conditional clearance, which means that once the condition is cleared up, or that debt is cleared up that's listed in the demand, then that document can be deemed a tax clearance.
Okay.
If we pay what they're...
So when that happens, I've never had that happen in any of my closings, but when that happens, it has to be taken care of before closing, or can it be paid out of the proceeds?
It can be paid out of the proceeds.
Oh, okay,
yeah.
Good, good.
And that's, again, what you're relying on escrow to do. We're telling you that we're going to take care of these things, that we will make sure that this debt is paid off, and we're going to pay it off before the seller can get their proceeds.
Okay.
So it's deducted before we pay out to the seller.
Okay. Well, I know at least 3 or 4 days before closing, you always prepare a closing statement for the buyer and seller, and I thought maybe you could share with our audience today kind of what that closing statement looks like.
Sure. Closing statement is each party, each buyer and seller, are each given their closing statement, and they're kind of a mirror image of one another, a series of debits and credits that just show the money that's coming in, so the money that the purchase price of the business, and on the buyer's side, for instance, added to the purchase price of the business may be sales tax that's going to be due on the sale of equipment.
Furniture, fixtures, and
And
equipment.
that's something we might want to go back to, the sales tax on equipment, and we can jump back to that.
I think we're going to go to that's going to be one of the
allocation.
Yeah.
Okay, all right. And so, again, added to the purchase price might be the sales tax. There might be some prorations that we're going to add to the to that amount, and we come up with a number that the buyer has to give us, and then we're going to deduct from that anything that the buyer has already put in. You know, we'll give the buyer credit for money they've already put in.
And the escrow fees, they share that, so that'll be
escrow
taken
fees
out.
will be shared. On the buyer's side, the seller is going to be given credit for the purchase price, and then any payments that are going to be going out are going to be deducted from that credit. So again, closing statements are just a series of debits and credits that have to match up, and that's something I have to do when I'm preparing these. I have to make sure that I balance. And so it's just a series, again, of checks and balances.
Okay. So you mentioned prorations, which is going to be on there, and that is when a seller sells his business, he may have paid some things in advance.
Yeah, and we may be closing in the middle of a month, and the seller has paid rent for the month, so we'll prorate that expense.
Okay.
And I will charge the buyer accordingly and credit that amount back to the seller. Same can go for some various taxes. We can do that. There are some expenses that are paid in advance.
Used to be Yellow Pages.
Right, used to be Yellow Pages. You don't see that too often anymore. I can use like a security system as an example. They might pay 3 months in advance on a security system. So, okay.
Okay, I'm sorry. So the closing statement is something that the buyer and the seller will get ahead of time. If there's any discrepancy or anything's wrong with it, then they will.
Right, we will adjust it at that point. I take information in, maybe some of the information that I picked up is not correct, or I interpreted it differently. So the few days before closing gives us the opportunity to get everything correct, get everything right on that closing statement.
Good. Let's move on to the next one. Whoops, I think I went too fast. We referred to an allocation of purchase price. This is one of the forms that I try to get done as close to opening escrow as possible, and it basically is when the buyer and the seller will agree on how that purchase price is going to be allocated in, I always call them buckets, which bucket they're going to put it in. And some of those buckets might be furniture, fixtures, and equipment, and I know that's one that the buyers have to pay sales tax on, correct?
Right. When you allocate to fixtures and equipment, furniture, fixtures, and equipment, it's going to be taxable at the tax rate for the county or the city where the business is located. Mm-hmm. So it just like you go into Sears and buy your refrigerator and you pay sales tax on it, or when you purchase a used car from a private party, you're paying sales tax on it. You pay sales tax on the fixtures and equipment of the business each time it sells.
I hate that.
Yeah, I know.
They've already paid it once, and now they're getting it again.
Yeah.
So basically, for the audience, the allocation of purchase price form is really for tax purposes, and of course, the seller wants to get treatment of capital gains on as much as he can versus ordinary income, and the buyers like to have as everything amortized in a shorter period of time as they can. Mm-hmm. And there's some things you just can't do anything about, like furniture, fixtures, and equipment. It's typically 5 to 15 years on, depending what you're doing it over. Another one could be leasehold improvements. I don't typically put too much into that. If it's a franchise fee, that might be another bucket. Goodwill is probably what the sellers like to see the majority of the purchase price put in, because that is taxed as capital gains versus ordinary income. And but the buyer isn't that crazy about it because it's got to take 15 years before.
But in many cases, the goodwill is the bulk of the sale. That could be what the buyer is buying.
Right.
Is that
a lot
reputation.
Of service businesses, right?
That's right.
That's it. You don't have big pieces of equipment and lots of vehicles that go with
or
it.
It could be a customer list, you know, an accounting practice, for instance. You're buying that customer list, or a any type of a service business, and you're selling them your clients.
One other bucket is called training and consulting on the allocation of purchase price, and training and consulting for the seller is going to be ordinary income, which could be 40% versus 20%. And so, you know, a buyer may say, gosh, this $300,000 business, I'd like to allocate half of it towards that you're going to be consulting with me, because I get to write that off immediately, and they love that. But a seller usually says, oh no, I don't want to pay ordinary income, so let's agree to $50,000 or something. So it is a give and take, isn't it?
It is, right. You know, when the form is given out at when we open the escrow, or even prior to, which is more ideal, the parties, it's something, they work on it, and then there has to be a meeting of the minds. They do have to agree on the allocation, because they'll be reporting it the same.
To the IRS.
For their tax return.
So, you know, I've heard people say, well, he can put what he wants, and I can put what I want.
You cannot do that.
And you can't do that, because it will come back to bite you.
Yes.
Inventory is on the list as well, and that's ordinary income to a seller. And for the buyer, it's cost of goods expensed. Let's see, covenant not to compete is an interesting one. It really doesn't benefit the buyer or the seller because the buyer has 15 years to amortize covenant not to compete, and the seller pays ordinary income on it. So we try to keep that category as low as possible. You don't really want to eliminate it, but you need to put some value on it.
Well, if there is a covenant, you do have to put
Yeah.
some value to it.
Mhm.
That's right.
Have you ever done businesses that didn't have a covenant to compete?
There are some.
Really?
In some cases, the seller is saying, "I'm never going to do this again," and or
But doesn't the buyer still want that? I would still want it.
Not in every case. I mean, there are cases
okay.
where they just don't feel it's necessary.
Okay.
Yeah.
Accounts receivable will be on there. Work in progress. Vehicles. This is one that if a company, we just sold a business that had quite a few vehicles, and you want to not put vehicles in the same bucket as furniture, fixtures, and equipment, and that's because of a double taxation that
Well, right, you just need to break them out because
Mhm.
the sales tax that's due on vehicles will be paid directly to the DMV outside of the escrow
Mhm.
when the title is transferred. So you don't want to lump it together
It's just paid twice.
because you'll pay, well, you can get it resolved, but
Mhm.
the DMV doesn't know that the tax has been paid if it's not done through them directly.
Yeah.
So you just break it out into two categories. You have a category for vehicles and then a category for fixtures and equipment.
Okay. And the seller pays capital gains on vehicles, and typically the buyer can write that off over 5 years. So that's good. Bill of sale, that's pretty.
Sure, yes. So these are just documents that we provide as part of our service. The bill of sale, the covenant not to compete. We'll prepare any notes, security agreements, guarantee agreements. We prepare the amortization schedule. A guarantee agreement is used when the debtor is an entity other than an individual. So it might be a corporation or an LLC, and the seller is asking for a personal guarantee on that note. So again, we will prepare these documents. We have tried and true forms that we've used for years.
Mm-hmm.
We can prepare a corporate resolution when a seller is a corporation. You need that document in the escrow. It's important to have that.
And that's basically, for the audience, the buyer doesn't really know. I mean, they know it's a husband and wife owned business, but there could be 3 or 4 other part owners, and it really is where the other owners, if there are any, have to sign that they are agreeing to the sale.
Right. There might be other shareholders, and it's easy to would probably be easy to hide those, and so it's a good document to have for the buyer.
And we already talked about the closing statements.
Right.
And indemnification and hold harmless. I know most brokers get the buyer and the seller to sign that, which really is saying that the broker has not verified the numbers that the seller has given to the buyer.
That's right.
We don't do due diligence on that. That's for them to do.
And I think we have the same thing built in to our documents.
Right, that you've never done that. Okay. Oops, keep going twice. And just additional services?
That we provide that I'm very familiar with, ABC application preparation, and of course that's done when you're buying a restaurant or a bar and you've got a liquor license that needs to transfer. I oversee loan document signing. We work quite often with SBA lenders. There's a handful around that we use on a regular basis. We can file fictitious business name statements. I'll handle any prorations that are needed in the transaction.
So you do the math work on that?
I do the math. Well, the program.
Oh, the program does it.
The computer program.
Good. I feel even better.
And then I am a notary, so all documents that require a notarization can be taken care of in our office.
Great. Any landmines that can occur during escrow that you have seen that you might be able, I forgot to go over this one with you, but if anything comes to mind that has happened.
Sometimes information is not disclosed. to the buyer. In some cases, the seller may not have any idea that something is out there.
Okay.
That certainly can be a landmine when you come down to closing and you discover that there's a secured creditor out there that we hadn't been aware of, so that can come at the last minute. Lease assignments can always be a possible landmine.
So get those done early.
You want to get that done early, and I know one thing that Joan does that gives her lots of gold stars in my office is that when she brings her escrows in, the lease assignment or the contingency that has been taken care of, and that's really important because she's ready to open the escrow when she comes in. There's nothing outstanding, and the lease can be a big one.
It can be.
Yeah.
More so than, and maybe a gas station that had what is it called? That they had some leakage and they have to do.
Right. There could be. They have to excavate. They have to take up maybe take up the tanks. A big landmine that comes to mind is a secured creditor who hadn't perfected his lien, and in order to perfect a lien, you file a UCC-1, which is, consider it much the same as putting a deed of trust against a home.
Okay.
The UCC-1 puts a lien against the business or a business asset, and if that hasn't been done, and we handle a transaction, we do our lien search, nothing comes up, we go ahead and close the transaction. Buyer takes possession, the seller gets the money. I've had an instance where this secured creditor came back to the buyer and said, I own this equipment. And, they hadn't perfected it.
Wow. So that's something.
That's something that can, but in that case, the seller, in this case, was aware of this secured creditor, but forgot to mention it. So that's something that can happen.
But that's what worries me when people decide to close a business without an escrow or without these lien searches.
Absolutely,
because a lot of times the seller may try to talk the buyer into, let's just do it without escrow. There's usually a reason why they.
And I've seen where I have a couple of files where the buyer ended up inheriting $20,000 to $30,000 in tax liability because they paid the seller outside of an escrow. They just shook hands. In this particular instance, there was an ABC license. Buyer wasn't aware that you needed an escrow to transfer that, but the damage had already been done. He had already taken possession, paid the seller, and the seller owed, I think it was $25,000 in sales tax, and the buyer had to take that on.
Great. Well, I think we've all become aware of really the importance of escrow, and not trying to do it on the side is probably the best money you could ever spend to make sure that all those clearances, lien searches are all taken care of, so there are no problems. Let's see if we have some questions here. One of them is, Jordan, if I have deposits with a variety of different vendors, can these deposits be collected through escrow?
I've never, I've never been presented with that. I don't see why they couldn't, why it couldn't transfer. You transfer lease deposits through the escrow, and I actually have never been presented with a deposit that's with a vendor. So, but I certainly don't see why you couldn't.
Okay. And Jack asks, speaking of vehicles, when is the tax paid on the transfer, at closing or at the DMV?
For the vehicles, you pay the tax directly to the DMV. So I would not collect the tax on the vehicles at closing. It would be the responsibility of the buyer to take that document to the DMV and transfer title.
Okay, but the furniture, fixture, and equipment tax, do you collect that?
I do collect that, yes.
Okay,
at closing.
And it is the percentage for sales tax in the county in which the business?
In the city, because it sometimes varies by city within a county.
I didn't know that. Okay. If anybody else has a question and would like to talk to Sue, you see her number here, 408-370-5920, or any question about selling your business or any help that we can offer, please feel free to call us. I'm going to unmute you to see if there's any last-minute questions. Mute all, unmute all.
The conference has been unmuted.
Okay, is there any question that we didn't cover that you would like answered? Sue, that means you did a good job.
Thank you.
Thank you so much for getting on today, and feel free to go to our webpage, sunbeltbayarea.net, and we have, probably 15 or 17 webinars on different phases of your exit strategy. So thanks again, and have a wonderful day. Bye-bye. Bye.